Sometimes the question arises, at what point should I be looking at which stock? Now, this depends on what your goal is. Often these so-called selections are made randomly, but here you should have a very clear strategy. If you invest in stocks, it is very important to distinguish between two types of stocks. There are growth stocks, often technology companies that do not pay dividends, and there are dividend stocks, which are primarily focused on providing dividends. And here is one very important difference that is often overlooked. Now, the dividend that the company pays, let's say for example 5% per year, is actually like a safety cushion, something that's essentially guaranteed for you. It's the return you can definitely expect to receive. Now, if the company's stock price increases and that 5% is your dividend income and the growth is, for example, 10%, then your total return for the year would be 15%. So that safety cushion of 5% is a guaranteed return, plus any additional 10% growth. Now, if you have a technology stock that doesn't pay dividends and the company, for example, drops by 10%, then that minus 10% is what you as an investor get. But if the dividend stock drops by minus 10%, then that 5% helps to offset the loss. So it's like a safety cushion, and your so-called loss is only 5%. So a dividend stock is definitely suitable for a conservative investor, often for someone who wants cash flow, who already has a sufficiently large amount of capital built up, and who wants to take less risk but still wants to receive a steady return. And often, so to speak, these choices are made randomly, but here you should have a very clear strategy. If you want to grow your capital, then it makes sense to look at growth stocks. And if you want to receive dividend income, that is cash flow, then you need to look at those dividend stocks. Now, sometimes the question arises, at what point should I be looking at which type of stock? Now, that depends on what your goal is. If you want to grow your capital, then you probably have more opportunities with those growth stocks. Take the technology sector, for example, where the so-called growth opportunities are greater, but at the same time, the risks are also higher. In other words, it is much more volatile and can also fall significantly more. Now, if we take a real example, let's say you have 10,000 euros to invest today and you buy a dividend stock that pays you 5% per year. This means that you receive 500 euros in dividend income each year, and if you divide that by 12 months, the amount you get each month is actually quite small. So in terms of standard of living, it doesn't really move you forward that much. However, you do get a small additional income for yourself. Now, perhaps at this stage, when you only have 10,000 euros, it might be better to focus on growing your capital and turning that 10,000 into 20,000, 50,000, or maybe even 100,000 euros. And now, for example, if you have, say, I don't know, assets worth 1 million, and you get 5% from that, then that 5% is 50,000 every year. And if you divide 50,000 over 12 months, that's already quite a significant amount, which could cover your living expenses. So depending on where you are, you also need different instruments to choose from. So often, those who are on their financial freedom journey, maybe at the second or third level, primarily want capital growth. In other words, they first need to grow that capital. And once you have already grown that capital, then you want to get that cash flow that would cover your living expenses every month. So look at where you are on this journey map today, and based on that, choose the right strategy for yourself.